In March of 2026, the United States crossed the line no country has ever crossed before. Its national debt passed $39 trillion. To put that in perspective, it's now growing by about $1 trillion every 5 months. And here's the moment that made it real. Last year, for the first time in history, the US government spent more just paying interest on that debt than it spent on its entire military. And this isn't fringe commentary. Congress's own budget committee put it in writing. So a whole industry of online doomsellers will tell you this is the end, a collapse, a great currency reset that wipes out your savings overnight. But here's the thing they don't tell you. The scariest number in this story is also the most misleading one. The truth is more subtle and far more useful to you as an investor. So let's do this honestly. What's real, what's hype, what the smartest money on the planet is quietly doing about it, and what it actually means for your money. Let's get into it. First, the number itself, because the scale of it really is hard to picture. In the year 2000, the national debt was under $6 trillion. Today, it's over 39. It's nearly 7 times what it was back then, and it's more than doubled in just the last 15 years. This is the chart that scares everyone. And it should get your attention. It became front-page news in 2026, when the debt crossed $39 trillion for the very first time. But here's the first honest catch. That $39 trillion includes almost $8 trillion the government basically owes to itself, money sitting inside the Social Security and Medicare trust funds. Strip that out, and the number economists actually watch is the debt held by the public. And even that cleaner number is at a record. Debt held by the public is now around 100% of the entire economy, and the Congressional Budget Office projects it keeps climbing, past the all-time record set right after World War II. And it keeps climbing for a simple reason. Washington spends roughly $1.9 trillion more than it collects every single year. That yearly gap, the deficit, is what piles onto the debt. It's a line America hadn't crossed since the Second World War. So yes, it's enormous, and it's rising. But debt by itself isn't what breaks a country. What breaks the budget is what that debt costs to carry. And that cost just exploded. Which brings us to the number that actually matters. And it's the one almost nobody was talking about 5 years ago. This is the US government's annual interest bill. In 2020, it was $345 billion. Last year, it hit $970 billion, nearly triple in 5 years. The CBO expects it to roughly double again, past $1.8 trillion within the decade. The figures are almost cartoonish now. The Treasury pays roughly $3 billion a day, just in interest. As a share of the whole economy, interest just hit 3.2% of GDP, a record breaking the old peak from 1991. It is now the third largest thing the federal government spends money on. Only Social Security and Medicare cost more. Put another way, the government now spends about $88 billion a month on interest alone, roughly what it spends on the military and the entire Department of Education combined. The Peterson Foundation, which tracks this obsessively, put it bluntly. But now the honest part, the doom videos skip. The US cannot be forced into bankruptcy. It borrows in its own currency, and it controls the printing press. So the real risk was never a sudden collapse. It's slower and more boring, interest quietly crowding out everything else. Okay, but what about the part that really gets people scared? The idea that the dollar itself is being dethroned as the world's money. Here's the chart they show you. The dollar's share of the world's official reserves has fallen from about 72% in 2001 to roughly 57% today. That looks like a steady decline, and it is real. But look at who's supposedly replacing it. Even at 57%, the dollar utterly dwarfs everything else. The euro is around 20%, and China's yuan, the great challenger, just 2%. And in the plumbing of global finance, the dollar isn't even slipping. It's on one side of 89% of every currency trade on Earth. And that share went up, not down. The yuan's reserve share has been stuck near 2% for almost a decade. And it's not just reserves. The dollar still sits on one side of around half of all global payments, and over half of all world trade is priced in dollars. China's yuan, the supposed challenger, barely registers. Even the Federal Reserve, studying this directly, isn't worried about the near term. So the headline, the dollar is dying, is badly overstated. There's no replacement waiting in the wings. But that doesn't mean nothing is happening, because the world's central banks are quietly doing something very telling. Because while the dollar keeps its crown, the people who manage countries' money have started hedging their bets, hard. For most of the last decade, the world's central banks bought a few hundred tons of gold a year. Then starting in 2022, that more than doubled. Over 1,000 tons a year, 3 years running. The most aggressive gold buying since the 1960s. And the price has gone vertical. Gold sat near $1,800 an ounce for years, then it broke $3,000, $4,000, and in early 2026, it touched an all-time high above $5,000. It's at 53 record highs in a single year, and the gold rush isn't a rumor. It's record-breaking news. And they're not done. In the World Gold Council's latest survey, a record 43% of central banks said they plan to buy even more gold, and nearly 3/4 expect the dollar's share of reserves to keep falling. That's the real signal. And it's not who you'd expect leading it. It's emerging economies. Poland, China, Kazakhstan, Turkey, quietly stacking gold, ton after ton. Here's the single most telling statistic in this whole story. For the first time since 1996, the world's central banks now hold more of their reserves in gold than in US treasuries. Quietly, gold has overtaken American debt. So this is what the real reset looks like, not a dramatic overnight collapse, a slow, deliberate diversification, the world's reserve managers quietly trading a little less dollar for a little more gold, year after year. Which leaves the question that actually decides how this plays out. Who keeps lending America the money? And here's where the doom narrative falls apart, but also where the real crack is. First, the myth. You'll hear that foreigners are dumping US debt. They're not. Foreign holdings of treasuries just hit a record high, $9.5 trillion. Japan, the single biggest foreign lender, is actually buying more, not less. There's one real exception, China. It has cut its treasury holdings to about $650 billion, the lowest since 2008, and down by half from its peak. That's a genuine, deliberate retreat. But it's one country doing it slowly. China's retreat is real enough to make headlines of its own. But here's the crack that's actually real. Even though the dollar amounts are at records, the foreign share of the debt has quietly fallen. From about a third in 2015 to under a quarter today. America increasingly has to fund itself. And you can see the nervousness in one number, the term premium, the extra yield investors demand just to hold long-term US debt. For years it was negative. Now it's the highest since 2011. Lenders want to be paid more for the risk. And that changes everything. The buyers are shifting, from price-insensitive central banks, who bought no matter what, to price-sensitive private investors, who demand to be paid more for the risk. You can see it in the rising premium on long-term bonds, now the highest since 2011. That, not a collapse, is the real fragility. So after all of that, the 39 trillion, the interest, the dollar, the gold, what does it actually mean for the person trying to protect and grow their money? Start with the dollar's own price. The dollar index fell about 11% in the first half of 2025. Its worst start to a year since 1973. Not a crash, but a clear, steady loss of purchasing power. Wall Street even has a name for the trade betting on it, the debasement trade. And history is fairly clear on how a debt this size ends. There are really only three ways out. You grow your way out, which is hard. You tax your way out, which is unpopular. Or you inflate it away, letting a slowly weaker dollar quietly shrink the real value of the debt. That last one is the path of least resistance. And here's what that environment actually rewarded in 2025. Gold at record highs, international stocks, which beat US stocks by a wide margin, and inflation-protected bonds, paying their best real yields in 15 years. This isn't advice, it's the historical playbook for a slowly debasing currency. Because here's the honest bottom line. The real question was never whether the dollar will collapse tomorrow. It almost certainly won't. The real question is whether it slowly loses value, year after year, while interest quietly eats the budget. And the evidence says, probably yes. The doom sellers want you scared because fear sells subscriptions. The truth is calmer, and far more useful. You don't prepare for this by panicking. You prepare by owning real things, staying diversified, and not betting everything on any single currency, including the dollar. If this gave you the honest version of a story that's usually sold with fear, do me a favor and follow Market Minute. Next time I'll break down exactly how the debasement trade is playing out right now. I'll see you there.